Hey everyone, welcome to the KE Report and a daily editorial on Thursday, July 3rd. Just as a note, I hope everybody down in the US, all of our US listeners, have a happy July 4th, Independence Day tomorrow. Get some time, hopefully, in the sun in front of the barbecue and away from the markets. We are with the daily editorial today, though, with Marc Chandler. Marc is the managing partner at Bannockburn Global Forex, also editor of the Mark to Market website. Marc, there's a bit for us to talk about today in terms of the jobs data that came out. But then next week, and who knows, maybe even tomorrow, we have some more news that we should look ahead to. That's tariffs potentially coming back, tax bill, also Fed policy, all these things that could drive markets. But first and foremost, let's go through the jobs data. We saw a headline print of 147,000 increase in payrolls. This beat estimates. I know some people are also poking holes in this jobs report, still saying that the job market is generally slowing just at a slow pace. Marc, what did you find interesting about the jobs data today?
Sure, thanks. I think the most interesting thing is that we were all wrong about it. We were like sort of like Hansel and Gretel's story, following the breadcrumbs. Here's what the breadcrumbs said. Weekly initial jobless claims elevated, continuing claims elevated. And by that I mean at a couple year highs. We had earlier this week the ADP private sector jobs estimate. It fell. That is, we lost jobs according to ADP for the first time in a couple of years. So everybody was leaning towards a weak jobs report. Instead, it came in better than expected. Not only the headline number that you mentioned, Corey, but also the unemployment rate, rather than ticking up, it actually fell. It slipped to 4.1% from 4.2%. And the hourly earnings also slowed to 3.7%, down from initially 3.9%, but that was revised. But bottom line is the jobs data was generally stronger than expected. We got the dollar bounce. We had a big jump in U.S. interest rates on the back of that. The market has taken it to mean that a July cut that some people were speculating on after a couple of Fed governors said they'd want to discuss it, that has been taken out. And the market has gotten second thoughts now about the possibility of a September rate cut. It's still the most likely scenario, but less investors seem to be less confident than they were before the jobs data.
Well, Marc, when you think about the jobs data and how it came in, yeah, it's a little bit different than how people were initially imagining it to be. But I guess the question remains, does any of this economic data truly move the Fed off their position of just waiting to be, they've been data dependent, but they've been waiting to see something that would cause them to start cutting sooner rather than later? The market, talk about being wrong, has been wrong the last 2 or 3 years on Fed funds futures when we were in the hiking cycle and on this cutting cycle. They've been too aggressive one way or the other the entire time. So if we want to look at a market that's been the most wrong, it's been the Fed funds futures. Does this data from the jobs do anything in your mind to move the Fed closer to a cut?
I don't think it moves the Fed closer to a cut. I think that most likely the Fed still cuts in September. By that time, the tariff, which is this key source of uncertainty, will be clearer. And I think they will have further slowing of the U.S. economy. And so both of these factors, I think, lead the Fed to cut in September. Remember in the July summary of economic projections, the median dot still favored two cuts this year. And I think that still is the most likely scenario.
Marc, I've seen some people poking holes in this jobs data due to the labor force participation rate. We see this falling, hence why the unemployment rate isn't rising. How does this also tie in with the whole immigrant issue here, where the U.S. seems to be deporting a lot of people? What's your thought, again, on the labor force participation rate falling and then also how deportation plays into that?
Yes, I think that the decline in the labor participation rate helps explain why the unemployment rate ticked down. I think that's consistent with like my broad view, and I think other people's about the gradual slowing of the labor market. And I think you're right. The immigration story and immigrants, that is to say, non-workers not born in the U.S., made up a large part of the increase in the labor force in the last couple of years. And that's no longer going to be there. But at the same time, it looks like the demand from the hospitality sector, broadly hotels, restaurants, that kind of thing, and construction seems to have slowed a bit And so this means that at the same time that we're getting a slower growth in the supply of labor, we're also seeing maybe some early signs of weakening demand.
Well, Mark, with the U.S. equity markets ratcheting to new highs this week in the face of earlier in the week what seemed like it could be a bad jobs report, I guess it also begs the question, does any of this economic data even really move the needle anymore for more than a day or two?
Well, it depends on what you mean and your time frame. I think the fact that the U.S. economy is still holding on, maybe even better than people expected. You know, later this month we'll get the Q2 GDP numbers from the government, and I think it's still very messy. But I think that it'll be clearer in Q3 and Q4 what's going on. And remember, too, that there still is, Fed policy is restrictive, but it's not the only game in town. The weaker dollar helps offset some of that when you think on a trade-weighted basis and what it means. So I'm not so sure that the Federal Reserve has a foot on the brake so much. So when it's lifting it, it might not, it might not be as dramatic of an effect. I think that the next big focus is going to be on the balance sheet. We've already seen comments, the Bank of England, unusual for the central banks, they're actually outright selling British gilts, not just letting the maturing issues roll off like the Fed does or the ECB and the Bank of Japan. So I do think that these numbers do matter. I think when you're thinking about growth of the economy, projecting policy, and remember we're going to have we've got other types of stimulus coming forward now.
When you talk about the other types of stimulus, are we talking about this tax bill? Because quite frankly, this tax bill looks like it's going to be tax cuts, a lot more spending. It's going to be brutal for the deficit, but I think we all have seen the more spending the government does, the better markets can hold up.
Oh yeah, if you were to tell me that, when we talk about the government's cutting this or cutting that, what does it mean when the government cuts spending? What do they spend the money on? It turns out to be some other people's income. The governments, and this is the remarkable thing, maybe for our grandparents, having a government debt, having government expenditures, not even looking at how they finance it, but government expenditures, a third of GDP. That means that the real problem, that I think underlying problem, is aggregate demand. In the U.S., the federal government spending over a third of GDP, this is at the low end of countries in Europe, say, and other G10 countries. So we still really need the government spending. The problem is, how do we finance it? And I think that so really two questions really. One is, how do we finance it? Do we do it with revenue or do we do it with borrowing? And the other issue is, how are the gains and pain distributed? And I think what we're going to have as this budget begins, the budget's in its final stages, most likely it's going to be approved in the next day or two, that we're going to see, so that is to say, the 4th of July, we should be able to probably pass this budget bill. And I think what we're going to see is a larger deficit, and not only a larger deficit per se, but also the way that the gains are distributed is going to lead to greater disparity of wealth and income in the United States. And I think this is what, I don't think that it's reached a point yet where it becomes destabilizing for the markets, but I think that as a political factor, it's important. I know many people are concerned that the debt and the deficit levels are not sustainable, and I agree, but it doesn't mean that they're going to stop on a dime. And I think if the markets are very concerned about it, we would see U.S. yields much higher. Before the jobs data came out, the U.S. 10-year yield was off about 20 basis points in the past week. And I think that if we saw what happened in the UK, not only in trusts in 2022, but even this past week, when it looked like the fiscal pressures were spilling over in the UK, we saw in one day a 15 basis point increase in the 10-year UK gilt and a big sell-off in sterling. We're not really seeing that with the dollar. And so I think that, yes, these situations not sustainable. And to Shad's point, does it really matter? And I think in the short run, probably not.
Well, and Mark, we should also point out for the last 4 or 5 decades, every administration has spent more than the previous administration on fiscal policy. We've had an untainable debt load for a decade or two. It's mathematically unpayable at this point with the amount of receipts we have coming in from taxes. If we're doing tax cuts, the philosophy there from the conservative side of the aisle is that it's going to stimulate businesses. On the liberal side of the aisle, they're concerned that we're not collecting enough through taxes. So if we layer tariffs on, some people believe that the Trump administration's plan to replace the money that's not going to be taxed is going to be through tariffs. So how does that play into what we may see next week on the 9th?
Oh yeah, I think that, to me, the administration's defense of tariffs seems to be on several different grounds, and they're not all consistent. So, for example, if tariffs are supposed to bring production back into the U.S., then over time you'd expect to see those tariffs reduced. The imports then would naturally fall, and there would be a decline in tariff revenue. So that'd be a short end thing if it's just if that's the goal. If the goal is meant to raise revenue, you probably want a low tariff and that can be sustained over time, as opposed to changing people's behaviors. And I think that there's the other factor behind the tariffs, and that is also this like challenging the type of globalization we've seen, especially since the end of World War II, where it is really about, think about globalization. It's not simply about trade. That's sort of like a shallow relationship. The deeper relationship is foreign direct investment, building plant and production outside of your country. And that is where the supply chains come in. And so I think that Trump, many of the people he surrounded himself by, don't really accept this form of globalization, think that we've hollowed out America or that we've lost manufacturing jobs because of this, or it's a criticism of the type of globalization we had. And I just think that these goals of the tariff policy can't all be met. And so at the end of the day, I think that the tariff revenue, it might last for a year or so. But we are seeing companies eat some of that. I was looking at some of the Japanese auto prices, and they're only up, say, a few $100s to a couple percent in the face of these 25% tariffs. We'll have to see how it plays out over time. Maybe initially, companies are willing to accept a smaller profit margin if they think the tariffs aren't going to be sustained. And I think that, again, the big thing for next year, of course, is the midterm election. And there we could see the administration's power curbed a bit.
This all seems like such a dangerous game the U.S. is playing. And to your point about foreign investment, too, the U.S. does depend on a lot of foreigners also to fund this debt. And yes, rates haven't spiked higher, but quite frankly, rates have consolidated for the last about 2 years at levels we haven't seen in 20 years. So that does make it more expensive for the government to continue to fund itself. And honestly, any shock to the upside in rate seems like it could be kind of devastating for the U.S. But Mark, I realize, look, rates haven't spiked, but as I said, they're at levels we haven't seen in 20 years, and this is with so much higher debt. So could the U.S. even withstand higher rates with, again, this tax bill and this whole concept of tariffs bringing in money? Still questionable.
I hear you, Corey. I think you're right. Though for me, I would shift the emphasis a little bit that the U.S. has stopped relying as much on foreign demand for U.S. treasuries. These days, the biggest holders of U.S. treasuries are domestics and domestic institutions besides the banks. Think about Social Security. Think about individual investors, pension funds. And we talked about this before about the stable coins. I think the largest stable coin has over $100 billion of treasuries. So we are seeing other sources of demand for treasuries, but I think you're right that this idea of these, 6% budget deficits for as far as the eye can see, the larger debt, I think it really, people wonder about how the story ends. And I think this is what gets me is that, there's an article, Martin Wolf, a great economist in the Financial Times, and he was supporting some ideas that have been circulating that the U.S. should tax capital imports. Now, we've been providing this public good besides our defense. Another public good the U.S. has provided is access to the deepest, most liquid, most transparent market in the world, the U.S. Treasury market. And some of the people that Trump has surrounded himself by have suggested that maybe taxing those capital imports. And Martin Wolf seemed to endorse that. And to me, there's always been this unspoken possibility of an exit tax. If you have US dollar exposure and you look at US debt, central federal government debt, you look at the deficit, you look at the net international investment position, how much we own, the US owns of foreign assets, how much foreign investors own of US assets, and you get this picture of a very highly indebted country. And if that's the case, if you buy U.S. assets, in the back of your mind, I think many people assume that they're going to see dollar depreciation, even though that hasn't been the case for a decade or so. I think that's come back to the fore. There is a quiet, unspoken exit tax risk, and that is the dollar depreciation given this debt burden.
Well, Mark, when you think about the taxes being cut, how it's been presented in the media quite often is that, hey, these are tax breaks for the rich and it's just going to help the rich. But I think one of the philosophies behind cutting the taxes goes back to the Reagan era, Reaganomics of if you cut taxes for businesses and for individuals, they'll have more money, but they could also hire more people, so that could help on the job side. They could expand their business. That's the thinking behind it, at least, that by doing tax cuts, it's actually going to generate more revenues for the government by an expansion of business. Do you think we're in an environment where that's even possible?
I think you're right, Chad. I think that sort of called trickle-down economics is part of this ideology, and it goes. I think you're right. From Reagan, it's through the Democrats, and now through Trump as well. This idea that you want the birds to eat more, you feed the horses. And I think at the end of the day, it doesn't really work so well like that. But I think that the jury's still out on this, and I think there's some lessons, even as traders, sometimes there's some lessons. I know for myself, I've had to learn many lessons more than once. And I think this is another lesson that we're going to have to learn. Can you cut taxes on rich people and on corporations and expect that the average person to be living better or worse?
Yeah, we'll see. It seems like all this just filters to the rich more so than anybody else, but the rich also keep the stock market elevated too. So again, that's why markets can disconnect from the underlying economy and what individuals, what citizens are truly feeling in terms of these tariffs potentially coming back July 9th next week. Mark, what should we be expecting here? What's the market going to do? What's your insight into this?
Yeah, I wish I had insight. I'm just prepared for more volatility. Partly the market knows what's happening, and at the last minute, the unpredictable nature of the administration, it could be a delay. Treasury Secretary Bessent has talked about the possibility of a delay that is extending the postponement beyond July 9th. We've also seen the deal with Canada maybe stretches out till late July. I think it's July 21st or something like that. So the deadline could be a bit fuzzy, and the administration seems to be impulsive. And so that uncertainty, I think, translates to higher volatility in the markets. Fasten your seatbelts.
Well, Mark, as we look abroad outside of the United States, we've laid the case here for a lot of these U.S. potential catalysts with fiscal and monetary policy, with tariffs, but there's a lot of other central banks doing a lot of things in other countries. There's a lot of other things that affect the U.S. dollar index. So, just as it relates to the greenback, what international forces could lay either a tailwind or a headwind to the dollar outside of the U.S. policies?
Yeah, Shad, next week is going to be a pretty quiet week for economic data. Two G10 central banks meet, Australia and New Zealand. Australia is most likely to cut interest rates 25 basis points. New Zealand, who's much further ahead in their interest rate cycle than the RBA, are likely to stand pat. If there's a surprise, it'd be that the Reserve Bank of New Zealand cuts rates too. The market has another cut discounted, but not until later this year. Broadly speaking, I think that as we get into here the second half of the year, I think that we'll see that many economies in Europe probably peaked in Q1, slower Q2, but the central banks, because of the lag of monetary policy, by the time the Federal Reserve resumes their rate cuts, call it September or maybe even later, that other major central banks will be just about done with their easing cycle. I think about the ECB, the Bank of Canada, the Reserve Bank of Australia, a couple of the Scandi banks. So that's my concern really in the big picture of things is that other central banks have front loaded their rate cuts and now the economies are going to be weakening. The US has sort of held back their rate cuts. The economy, I think, is going to be slowing in the second half of the year. And by the time the Fed resumes its cuts, these other central banks will be just about done. And I think that interest rate divergence will be another factor to weigh on the dollar.
Yeah, that's the thing. Could push the dollar even lower because the dollar's trend is definitely down right now and doesn't seem like anything can save it. Plus, all the talk we're getting out of the White House rate cuts, who knows about tariffs, indecision. Just doesn't seem like a good picture for the dollar. But hey, markets are still holding up there. Again, that disconnect that we have seen time and time again. Mark will wrap it up here. Again, Marc Chandler, managing partner at Bannockburn Global Forex, also editor of the Mark II Market website, which I will link to in the show notes. Mark, thank you for your time today. I hope you have a very happy and fun July 4th.
Thanks. Good luck to everybody.